In this video, you are going to learn more about market gaps, how are they formed, are the different types of gaps, and how also to trade in that scenario. So welcome in this beautiful video. If you are not a subscriber, remember to subscribe. And before I can get started, just give me a thumbs up. It benefits the channel a lot. So here we can see this chart here that this is a market gap. This is a market gap. This is also a market gap. This is also a market gap. So a gap, it is simply a space between the open and the close of the price. It is a space between the open and the close of the price, meaning if the price opens where it didn't close previously. If the price open where it didn't close previously, it forms a space which is called a gap. So we have different types of market gaps, but I'm just going to be specializing in two of them. We have common gaps, we have breakaway gaps, we have runaway gaps, and we have exhaustion gaps. So we have four types of gaps: common, breakaway, runaway, and exhaustion. But I'm just going to be speaking on the common and the breakaway. So the common gap, it is this kind of gaps which just occur in a market move, either in an impulsive or a corrective wave. So that's a common gap. But then the gap that happens in a range, we call that a breakaway gap. Why? Because usually, let's say the market is moving in a range like this, and then all of a sudden there is a gap here, then the market opens all the way, then continues to go all the way up. So it is called a breakaway because that's how the breakout happened. The breakout happened through that market gap. So we call it a breakaway gap. I hope that one is clear. So these are the two most common one. The common market gap, which happen just in a wave like this, either an impulsive or a corrective wave. Then the breakaway, it happens if the market was moving in a range and all of a sudden there is a gap and the market moves away from the range. It start going in a chosen direction, whether bearish or bullish. So now usually market gaps, they occur when there is some high impact economic news. That's the first scenario, where there is economic events with high impact. They cause the gaps to occur. Why? Because let's say the price was in $10, or the stock was costing $10, and all of a sudden the news, when they come in that minute, they just push the value of the asset down to, let's say, maybe $7. You see that it will be a difference between the actual price, which was the close. There is a gap here which is $9 and $8, so it will form a market gap. It wasn't now moving in an order, so it skip some of the units in between. I hope that one is clear. So that's the first scenario, when there are economic events which are of high impact. And then the second thing, it is usually when there is a break. When there is a break, or when there is no trading taking place, yet in real life there are some factors which causes price to move. For an example, if there is a holiday and the market is closed, but physically in the country, let's say we are speaking about the USD, physically in the country there are a lot of economic events, or there are a lot of financial activities going on in such a way that it will change the value of the asset or the exchange rate of that currency, while there is no trading taking place in the chart. So let's say tomorrow we are having a holiday. So today the price is closing at, let's say, I just want to make with good price, let's say at $10 again. Let's say just at $10 if it's a stock. So the price is closing at $10. However, tomorrow, as it is a holiday, there is a lot of things taking place in such a way that it pushes the value of that asset up while we are not in the market. So tomorrow the value goes up to $12. We are not in the market. The market is closed, but this is now happening physically. So it goes up to 12, it goes up to 13, and then after tomorrow the market opens. When the market opens, it will not continue from the $10. Immediately the market will just open at $13. So you see that now there is a difference between how we left the market and how the market is resuming. So that scenario, it is forming a market gap. So usually this is how you should trade it. This is how we should trade it. Usually when a market gap is formed, usually prices, they try by all means to cover that gap as price continues. For an example, let's say you were having selling trades here, and all of a sudden, let's say you sold here, then there is a gap. When the price is here, after you notice the gap, you should be closing your trades. Why? Because usually prices will try by all means to close or correct in a manner of closing the gap. Same thing applied here. We can see that indeed the gap, it was predicting something good. Why? Because it is pointing on the downside, but the market had to correct and cover that gap and then go down again. So same thing applies here. A gap upwards, the market corrects, it covers that gap. So you see that it usually has to cover that gap and then proceed with its own initial move. So when you see a gap, it means that you should stay away from your trade. And also it means that if you never had some kind of running position, if you're anticipating to go on the downside, you should be it should be giving you some kind of opportunity. But usually it is not long term. It depends on how the market is structured. So I hope that one is clear. When there is a gap, usually the market will try to cover it. Just as you see now, the market is moving upwards, trying to close this gap. The market closed this gap here, and it also closed this one with this kind of a candle. So this is things that are usually happening. So you see a bullish gap, you need to know that the market is about to go bearish and try to cover this gap. So for you to enter in a profitable trade, if you're not in a trade before, it is for you to wait for the market to show you signs of turning back, and then you put on your sells and make sure that you make sure that you monitor this trade, because it might be a short-term trade depending on the scenario of the market, just like it did here. It just was a short-term move and then all the way down. So that's it, guys, when it comes to market gap. So this is a very, very good approach that you can add in your trading. So I believe this was helpful. Thank you for watching this video.